meeting across many lands. I'm in the land of the Wurundjeri, Woiwurrung and Bunurong people, and we recognise their continuing connection to the land and waterways. We pay our respects to their elders past, present and emerging, and extend this to all Aboriginal and Torres Strait Islander peoples. So welcome everyone to our year-end webinar, and hopefully this goes well. Just in terms of how we'll operate, we've got some expert panelists who are going to talk, and I'll introduce them in a minute. But if you've got any questions, put them in the chat box. We've got 8 or 9 questions already presented. So when we get to those, I'll start putting those in the chat box, and the team will talk to those. But when we get to the question time, look, feel free to put them in the chat box, and if we have time, maybe you can come on personally and talk to those a bit later on. First of all, so we're here to give the opportunity for members to ask those burning questions about year-end. Of course, we all know that year-end's not 30th of June. It's all about July and August and getting to those audit committees at the end of August and September. So take this opportunity, and we've got 2 experts in the field. We've got Fiona Ray, who's the Manager of Finance at Golden Plains Shire, and John Brockway, who's the Manager of Financial and Business Services at Warrnambool City Council. And of course, we've got, and I called him the guru, and the man who wrote the book is Martin Thompson. He's a Senior Partner and Head of Audit at Crowe Australasia. So welcome to our panellists. And look, what I might do to start with, just give you each an opportunity to talk about what you think are the key challenges and probably some of the tips about year-end processes. And we might throw to Fiona first.
Thanks, Danny. So some of the main issues that Golden Plains Shire have faced this year, I'm not sure in line with a number of other councils, is the floods of October and November in 2022. So we've had a number of additional costs that that's impacted our operating result, and also the timing of claiming reimbursements will span into the next financial year. The damage of that's caused to some of our infrastructure assets, capturing that data, to have the evidence to be able to claim the reimbursements is a real challenge and very time consuming, and identifying and documenting those damaged assets, which will also flow into impairment of some assets. Some of our bridges have been impaired, have been damaged significantly, and will require impairment. We've also needing to look at reviewing some condition assessments for those condition ratings for some of those assets that have had some significant damage. So the floods have had a real impact for us. Also, the timing of the financial assistance grants, that surprise of receiving 100% paid in advance compared to that 75%, and having to recognise that extra revenue in the 22-23 year. Just the number of grants that we're receiving and the delays with projects, and having to then delay the revenue recognition of some of those grants. Those dollars are getting larger and larger, we're finding. And this year we've got some significant dollars that we need to push out into the next financial year. We've had a number of projects that are blowing out in costs. So just managing projects within budgets is a real challenge, having to reduce project scope, and a number of projects being delayed and not completed. So that's really going to impact how many projects we can capitalise this year. And we've also seen with some of the changes in the environment that a number of projects are going to be impacted, such as the number of tenders we receive, just with things being cancelled, such as the recent Commonwealth Games, that we've seen a real increase in the number of people tendering for projects. So that's impacting workloads in the team, and also going to impact how many projects we can get completed in time. We've had a number of impacts from new systems as well. So we changed our payroll and our asset management systems within the last 2 years. We've still got some flow on from some of those systems. We used our asset management system for year-end reporting last year for the first time. So still working through how to do a number of year-end processes in that system. So that's another challenge that we have at the moment. Asset valuations is a big one for us as well. So we're not due for a formal valuation this year, but do have to have we're sort of doing some assessments, and we do believe we're going to have some some real increases in asset values. So they're our main issues that we're finding challenges this year.
Thanks, Fiona. I don't know if there was a bit of a glitch at your end or my end, but it stopped there for about 2 seconds. But I think we picked up on the gist of it all. And for those, there's a few more people come in since we started. We've just done the brief introduction. Fiona has spoken. I'm going to throw to John and Martin in a second, but we are recording the session, so anyone who's coming a bit late, you'll be able to pick it up later off the FinPro website at some stage. And we might throw over to John.
Thanks, Danny. Look, we've had a lot of those similar challenges to Fiona. We've also had quite a bit of turnover, and I don't think we're Robinson Crusoe there. I think that's happening across the board, but we've had particularly large percentage, I guess, and in those important spots like CEOs and management, but also subject matter experts in asset management and things like that. We've had people doing 2 jobs. We've had that lack of knowledge or that brain drain from people leaving. The recruitment's been challenging, and also training up new people. So it's all happening all at once. It's been a bit of a tidal wave. There's a lot of external noise. We in particular have a pretty inexperienced council and a hostile press. So there's a lot of external noise, and that generates a lot of extra work. We're doing a major ERP upgrade as part of the Rural Council Transformation Program, which I know there's a lot of councils out there doing that at the moment. So timing's never great, but stuff you've got to do. Developers, particularly with our developer contribution plans, development's slowing down quickly and to a very low pace. So that's having an impact on our financial estimates as well. Rising costs, insurance, work cover, utilities are all going bananas. There's changes to the model accounts you just got to get your head around, and you just got to create space with all that stuff happening just to focus on the year end, which is always difficult. So some of the little things that are happening in the model accounts, like the balance sheet prepayments, the removal of the restricted and unrestricted cash, the additional disclosures for Note 6, and the revamp of the senior officer and KMP stuff. Just things to keep in mind as well. Thanks, Danny.
Thanks, John. And Martin, over to you. You're obviously the man behind a lot of the technical help with regards to LGV and Vargo in terms of working on the changes to the model accounts. So maybe, and from an expert audit perspective, try and give us your view of the year-end processes and what we should be looking at.
Yeah, thanks, Danny. I think, from an audit perspective, firstly, I think the year-end process, we're actually looking forward to what should be a reasonably smooth year-end across the sector. I note John's comments about some changes to the model accounts, but I think the good thing this year is that we don't have any, changes to accounting standards, and the changes to the model accounts are probably at the lower end of what we've seen in previous years. That said, I do think there are a few challenges, and I think Fiona touched on a couple around some of the impacts on asset valuations. Obviously had the floods in there. I think there's probably a more closer look at, I think I take a step back. I think where management are required to exercise judgments in the determination of financial statement disclosures, that's probably the area of greater focus this year. There are lots of changes in the environment that are making things a little bit more volatile. So things like the flood and the impact on assets, asset valuations generally, capitalising developer contributions, also capitalising things like internally developed software and any of those projects. Obviously, we've got software as a service and the impacts of that and limitations that places on some of those internally developed or internally capitalised items. The other area I think that will be interesting and a little bit more challenging this year and could have some sort of unexpected impacts is probably around the calculation of provisions. So, with changes in discount rates driven off the interest increases in interest rates and changes in inflation expectations, we could see some quite volatile movements in the provisions. I particularly would call out, I guess, any councils that have got the longer term landfill rehabilitation provisions. could be some substantial cost impacts flowing through and discount impacts on those. The other point that I think is interesting this year is that the model accounts have really flagged more of a focus on simplifying disclosures in the model and giving the preparers the option to remove disclosures where the information is not material within the report. So I guess that creates a bigger question, a bit of a challenge to the preparers to consider what should be in and what should be out. So I think, those areas with judgments, again, that's going to be where we're going to see some of our challenges this year, Danny.
Brilliant. Thanks, Martin. Now, look, we've got several questions that have been sent in before the start of the webinar. So I'll just put the first one up there. It's from Carolyn Reedy, Finance Manager at Frankston. What is the best practice regarding upcoming rollout of new glass recycling purple bins, which we are purchasing by our contractor? Should we capitalise or not? The control of the bins is all via our contractor and also the maintenance and renewal. So, and I know that's an issue that's going to be facing a lot of councils. We've got, I think, till 2027 to bring in the fourth bin, and in most areas, I think that's nearly all areas in Victoria. So, I'd be interested in finding out what the best way to manage that too. Which one of our panel would like to have a crack at that one? John?
Oh, you're on mute, John.
You're on mute, John.
That'll be a good one for the recording. Thanks, Danny. We talk about control, and I think the control actually probably sits with council, because council will be the one who tell the contractor where to put the bins. I think the control for the contractor is actually they control the logistics, whereas council will control where the assets go and how they're handled. I'd imagine the logo would also be on the bins. I've been at several councils that have rolled out the glass bins now, and we've capitalised them in both similar circumstances.
I think perhaps just briefly to add to that, I think generally you're right there, John. I think there might be some challenges around individual contracts in terms of measuring the actual cost or value of the bins and potentially pulling that out from the broader contract. That said, it doesn't change the underlying principle that, council, it's hard to see an argument where council aren't controlling those bins.
I'd love someone to come up with some solutions about how to fund the bins, but that's but I think I like the idea that you can go through your contractor. We've been considering that, at least talking to them about when that's going to happen in terms of the glass bin, and it's the bin purchase of, for us, probably about $3 million. It's my biggest concern.
Mm.
We've got another question. Peter Phelan from Northern Grampians. Discussions on grants unearned income would be helpful. Hints on making it easier to split between the two AASBs would be good.
Perhaps I could make a comment on that one, Danny. I think it is perhaps unnecessarily complicated when we're looking at grant income and how we're accounting for that. The key, whichever standard we're under, really is whether we are looking at a performance obligation under the grant that is sufficiently specific to defer settlement. And I mean, I know there's a sort of slightly different decision tree for capital works funding, but the general principle is, do you have an obligation under the grant agreement that is tied to the delivery of a service or a good? And I do apologise because it is a subjective assessment, but generally where we can pull out those specific objectives, sufficiently specific objectives, then we would defer settlement. In all other instances, we would recognise the income when we gain control over it. I think, the very simple examples are, where you have got a grant to deliver a certain number of hours of services. You can tie that into the delivery of services. Where there's not, like the financial assistance grant, where there's no, real specific performance obligation, then we're recognising that on receipt. So I know that answer is not necessarily the one that everyone wants to hear, but it is really about hunting out those performance obligations and making an assessment whether they're sufficiently specific that you would defer the recognition until you've met that obligation.
Maybe a couple of years ago, FinPro had a working group to review the introduction of these accounting standards, or the updated accounting standards. And there was a paper circulated at the time. It might be worthwhile, Danny, FinPro going back and recirculating that.
It's on, Gabriel might be able to confirm, maybe on the chat box. Well, I think that information is still on our website. Might provide a link to that if we can. Sorry, Gabriel, put you on the spot there. We've got a question from Olivia, but Olivia, I know we've got a couple of questions coming up on the remuneration of staff and the KMP. So if you just hold on with that one, because I've got a couple others we'll pose too, and I'll just work through, because I just want to work through the ones we've got, the pre ones. I hope you can hear me all right. I know there's problems with the microphone, I think. Oh, now I've got a problem here. The message is too long for this one. Just hold on. I'll just split it up. So I hope you can read that as I'm copying and pasting the second part. This is the longest one. So the question's from Errol Rose, Asset Accountant at City of Casey. The number of leases, office equipment, photocopiers, printers that have expired during the year. I've asked the person involved if we will be renewing the lease agreement. According to him, he's in the middle of an agreement with the supplier where there is no fixed payment for the lease. The payments will be based on usage and no fixed expiry date for the use, as we can pull out the contract lease anytime, pull out the contract at any time that we want. By the way, as the agreement has been put in place, we are still paying some fixed payments for the leases. So the questions are, is the expiry of the lease still, is the expiry of the lease still constitute a lease, even though it is expired, but we were still making a payment to them? And do I need to account for leasing till June, even though the leases have expired between December to February? I haven't accounted for any lease accounting, as I was told they were still in discussion with the new contract. Will I be incorrect in accounting for the lease as it was will I be incorrect in accounting for the lease as it will be continuing till October, when will be a decision on how the agreement will be done? When and if we go to the new agreement, which will be as per usage and no fixed term, but does that still constitute a lease? I'm sorry, it's a big question, but I don't know, Martin, did you want to?
Yeah.
Comment on those?
Yep. So I think it's simple and complex at the same time. So if the lease has expired, then, and you're paying on a month-to-month basis, whether it's on usage or whatever, then you don't have a lease that requires capitalisation. That's a short-term lease under the 12-month threshold, so you wouldn't be capitalising anything associated with that agreement. So, and that makes sense, because when we're capitalising the lease agreement, we are actually capitalising the benefit that we're contractually entitled to, and the obligation that we're contractually entitled to. In this instance, we're only contractually entitled for the month in question. It is important, though, to distinguish this from the situation where you've got a lease that's current and you're considering extending that lease under a term within that lease that allows for that extension. So if you make a decision to take up that extension within the existing lease, then you would reassess, remeasure the leased asset and the lease liability to take account of that extension. However, listening to this example, the lease has expired, we're on a month-to-month arrangement, so no capitalisation required. The second part of that question was, if you go to a new agreement which is purely based on usage without a term, does that still constitute a lease? Well, the short answer is yes, it's a lease, but again, if there is no term and it's simply your commitment's no more than a month at a time, then it is that short-term lease that wouldn't be capitalised. Again, contractually, and with leases, we're capitalising our contractual right and our contractual obligation. If it simply has no term and you can withdraw at a month, so at a month's notice, it would be not capitalised on the balance sheet. hopefully that's reasonably clear.
Fiona or John, did you want to make any comments on that in terms of how you manage those?
All good.
I don't really have much to add to Martin's explanation.
Thank you. Thanks, Martin. And Hannah's put a note in there. She's got a template working paper to help with the assessment of grants that they use at Mitchell. It's not perfect, but the auditors seem to think it's okay. And note there if you want to contact Hannah to get a copy. Thanks for that, Hannah. Appreciate that. Next question's from Carvey Christopher, Senior Finance Business Partner at City of Yarra. Can a reserve account be created to manage the developer contributions, e.g. drainage and road reinstatements?
I'll respond to that. I think, yeah, absolutely do it. What you're doing by creating a reserve account is effectively quarantining those funds for that specific purpose. Makes it pretty easy to track as well. I recently had a councillor kick up a stink publicly because they just looked at our finance report and saw that we were holding $40 million worth of cash. What that led to was a fair bit of work in justifying what we were holding the cash for, which is all legitimate. But having a well-maintained cash reserve register where you're allocating, things for a specific purpose, I think would have made it really easy for me to justify. I think Surf Coast, they do it really, really well. And I don't want to throw them on the spot, but have a look at the way they do it. It's really good.
Yeah, the only thing I'd add in there, the only thing, if you can create whatever reserves you could, just be mindful of are they cash backed or not, and just be aware that if you're going to have them as cash back ones, make sure they are cash backed.
Yeah, absolutely.
And we certainly do have reserves for developer contributions and open space reserves, and make sure that they're cash backed. Yeah.
So the next question is from Kay Davis, Management Accountant at Mount Alexander Shire. A general one about grant assessments under AASB 1058 and AASB 15. They seem to be overcomplicated. Can you advise some tips and tricks on how to account for them?
Probably refer back to my earlier answer where we talked about that performance obligation really being the key. So if you can't hunt out a sufficiently specific performance obligation, you're probably looking to recognise the revenue when you gain control over it, which would typically be on receipt.
Okay, we're getting through these. The next one is from Dennis Bastis from Manager Financial Services at Yarra, another Yarra question. How do you identify, assess and report on heritage buildings? And also changes in related party disclosures or other senior officers, which was a question we had earlier. So I think we might have a couple more of these too. May cause significant variance from last year. Do we need to change comparatives, especially given the change reporting to a KMP? So there's two parts to that. So how do we want to do the, who wants to have a crack at the heritage assets?
I'm happy to say a few.
John and Fiona are just defaulting to you every time, mate.
Yeah, no, we're not experiencing this. Go to the expert.
If there's ever a silence, I always feel a pressing need to jump in. But look, heritage assets, this is a real, we could have a one-day seminar on heritage assets in and of themselves. And it's important to note that heritage assets and buildings are probably a subset of heritage assets. So we can have a range of heritage assets covering, artwork and all sorts of other things. There is, and within the model accounts, there's already a classification for heritage assets as part of the process. I think in practice, most of the councils are recognising their heritage buildings within the buildings asset group. But certainly that's what I've seen. I haven't seen too many councils pulling out their heritage list, heritage buildings and separately putting them into the heritage assets. Tends to be more in the the artwork space where we see those heritage assets. In terms of the question around valuation, there are some challenges there. Obviously, when you engage your valuers, they will talk through a particular methodology. But I think there was a really good article put out by CPA Australia. It goes back a little while, and I can send a copy through, but it goes through the methodology for valuing heritage items, and also, I guess, the processes around understanding the definition of what they are and how to account for them. I think the broader comment I'd make in relation to them is it is a little bit complex, but again, for the vast bulk of councils, I think the heritage assets would tend to sit under the materiality threshold. So when we look at all of our roads and infrastructure and drainage and all of those assets, and we're down to our heritage items, there may be, it may not be so significant, but certainly, and I note this one comes from Yarra, some of those older inner Melbourne councils, that might be a different outcome. Hopefully that gives a little bit of an overview, and I will provide that article through for people that are interested.
Thanks, Martin. My first thought on that heritage component was obviously you'd have to have a difference in the age of the asset. That would be the standout, wouldn't it? And making sure that if you've got a 50-year life on a heritage asset, I'd say there's something wrong with your useful life component.
Yeah. I mean, the age is not always as like Sydney Harbour probably is a heritage building, heritage asset. Sydney Opera House is a heritage asset, and it's not. I mean, I guess it's 1970s or thereabouts. But you could have a lot of 1970s buildings that wouldn't meet that definition of a heritage asset. So it is beyond just the age. It's they need to have some sort of significance as well as that. So it is a little bit complicated. It's not as straightforward as it looks. But there is a bit of guidance bouncing around that I can provide to the group.
Right. There's a second part to that question was about the comparatives with the KMPs and the other senior officers. And I know we've got a couple of questions, and I'll post a couple of those as we're talking about it. So maybe John and Fiona, do you want to tackle this part of the? And I know this was a change that we fought pretty hard from a FinPro perspective to get this changed. And I know we were supported by Vargo particularly, and LGV came to the party in terms of changing it, just in terms of the senior officers and what's the term of a senior officer. So you guys want to have a go at that one, John and Fiona?
Yeah, happy to. This is a welcome change where we did have a number of senior officers or coordinators that were falling into that disclosure. So this change has resulted in a lot of those no longer being captured, which is a welcome change. We generally would try and update our comparatives in any change to disclosure. So that's what we'll be planning on doing in relation to this particular disclosure. So yeah, we'll be working through changing our comparatives to align.
Yeah, I think if you don't change the comparatives, you leave yourself open to criticism for people who probably have a very shallow look at the financials and don't understand them. So you might see some significant increases if you don't change them, and that might just cause you problems down the line.
Martin, is it a bit early. Have you come across this discussions with any of your clients?
We have had a couple of discussions with clients, but our starting position is the model financial statements, like the note says that comparatives will be updated to reflect the current accounting treatment. So our expectation is comparatives will be updated. There may be rare circumstances where that's not practicable. In those situations, we would expect that there'd be appropriate disclosure explaining why it's not. And to be honest, I'm not sure that there'd be too many instances where that would be the case in relation to this disclosure.
Thanks, Martin. Thanks, John. Now, the next question from Jacinta Torres, who just posted, Coordinator of Financial Accounting at Ballarat. And the first part one is about the comparatives again. The second part, what about if there's a change in the structure? Do the comparatives in Note 2.2 need to be restated?
I actually am going through this consideration at the moment. Just considering whether it's impractical to actually recreate last year and how much work will be involved with that. So I'm actually I'm struggling with the same question.
I guess for us, we've had some minor changes, so it hasn't been much work to change comparatives, but I understand if there's a major change, it could be quite a lot of work involved.
I think the starting point is the same starting point, that where practicable, you would update the comparatives to reflect the current reporting framework. But I understand if you've had a significant restructure of the organisation, then it may not be, and that's resulted in a change in the trial balance and the general ledger. You may simply not be able to code or map the trial balance to the new structure. So it might not be possible. So again, I think with all of these sort of circumstances, the note disclosure is the way that you explain why there's been differences. And I think that's the best way to address.
Yeah, I think in the model, we don't actually have in 2.2 notes as a part of that, but I would have thought that'd be something you could do, put some notes in, like you do with note 2 and 2.1, some notes about that, why there'd be differences, because sometimes it is difficult. I know we'll have one or two restructures across 100 programs, of course, but we'll have several restructures each year, so it can get a bit complicated. And the sentence third part, or term deposits greater than 90 days, does accrued interest go to financial assets or accrued interest?
That's a good question. So if the term deposit is greater than 90 days, it sits in financial assets. Is the question, I think the question is, do we then capitalise the accrued interest into the financial asset, or do we separate it out as part of the other asset being accrued interest? Again, I don't think this would ever challenge the balance sheet in terms of materiality. I think capitalising it into the financial asset would make more sense. So we would effectively increase our term deposits over 90 days to add or allow in, to include the accrued interest as well. Happy to take that one on notice, but I think that my first thought is that, and again, it's highly unlikely to be material, but my first thought is we would effectively increase the value of our term deposit to reflect the accrued interest as well.
Well, if you're okay with all that?
Yep, that's
happy
fine
with that. Yep, I agree with that completely.
So this is the last of the questions sent in. So please, if you've got other questions, start putting them in the chat box, or I'll give you an opportunity to put your hand up and come on and talk to it. So this last one's from Deepash Adashira, at my finance business partner at Mornington. How to manage the earned income register for the multi-year projects for the funding received from state and federal government?
So I guess my response to that one would be that you do the same assessment at the end of each year. So you would assess the income earned and what the current situation is at balance date as to the performance obligations being met. And then you do it again at the next year end.
Yep.
The alternative is you take it down the crown and put it on red, see if you can double it up. And you've got more. No, you probably shouldn't do that. I think that's right. And there is, like, for capital projects, there is it's still a very similar thing, but you can progressively recognise that revenue as you progressively complete or meet the performance obligation. So it's, if the performance obligation is to build a hall, if it's a capital grant, as you are progressively meeting that obligation, you can progressively recognise the revenue, which is really assessing the extent to which a performance obligation is being met at that particular point in time.
That'll be a problem in the future, Martin. There's a lot of good grants, some of the money's drying up in state and federal.
Well, yeah, I mean, which is another significant risk, or potential risk going forward. Just when our capital works, and again, if we flip back to replacement costs and those sort of considerations, Fiona made a really good point that we're seeing more tenders coming through now, more activity in the market. If the economy does sort of slow up a little bit, and if there is more availability of work or tenderers in the marketplace, we may see a reduction in the replacement cost that will potentially apply across the board in terms of valuation. So it's a little ironic that as the price for infrastructure potentially comes down, the ability to capitalise on that may also be limited as well, which is a bit unfortunate.
And apologies, I think I was talking to those questions, but I was posting them only to Gabriel, I think, because we had a messaging going behind the scenes there, and I think I was only posting those to Gabriel. So if I missed questions 4, 5 and 6, we talked to them and answered them. You guys did a good job of answering those, but I will post those back onto the questions. So I'd like to throw it open now for some other questions. If we've got any more particularly, or if you want to put your hand up, just come on and ask a question. So I've got Mark Eels. Mark, fire away.
So probably just a quick one, just get your thought on this, Martin, in that we've had back onto heritage buildings, we've had our revaluation done this year. It's a new contractor that hadn't, first time that they've been valuing our assets, and some significant shifts. And obviously, as an auditor, they look for the big movements, and there's the big movements, and we're not experts in the field, and we're trying to justify the movements from the previous valuer. Apart from the fact of calling back the valuer we engaged 2 years ago for them to discuss with the current valuer as to what the movements are. We can check the calcs and ask the questions, but I guess you're asking for a fresh valuation from the new valuers. But it's just throwing out big movements that us as accountants and financiers probably don't have the expertise to particularly in your heritage buildings, I guess, in your old town halls and all that kind of stuff. So that's just one of our big movements this year, and I'm comfortable with it, but it's just trying, comparative from 2 years ago to now, as opposed to what the data is.
Yeah, look, I mean, it's really difficult to answer without looking at the two sets of instructions in terms of what's gone out to the valuers and the valuers' reports themselves. What we have seen, though, in some cases is different interpretations of fair value for heritage buildings. So some valuations have not looked at the heritage value of the buildings as such, but have looked at what's the price or what would be the cost to replace the service potential. And so it's probably worth just digging in the back of the two valuations to understand whether there's been a change there. Now, both methodologies can be okay, but I would think it'd be worth, it should be in the narrative around the valuer's report as to how they've come up with those values, and it may be a difference between one perhaps considered the heritage value and one's considered the cost of the replacing the service potential of the asset, but really sort of need to dig in detail. Again, one of the things, and it's really easy to say this, we're hindsight, but having the conversation with the valuer specifically about what they're doing in relation to the heritage assets and how they're valuing those, and ensuring that you're comfortable with that approach is probably something that would be, really worth doing. And again, maybe you've done that, and maybe this is the right outcome with the current valuation. But yeah, I'd need to look more closely at the detail, I guess, to give you anything more informed.
Yeah, thanks.
Sorry, I was reposting some of those questions that we did before. There's a new one from Caddy at City of Yarra. As a general practice, capital operating grants are not accrued, even if the performance is completed for that milestone payment. Sometimes relates to admin delays to receive the payment. Can grant income be accrued in that case?
Yes, is the short answer to that question. So if you've got a grant agreement and you've met a performance obligation ahead of receiving the funds, then you can recognise that as a receivable, a grant receivable.
Mark, were you expecting to see that as an audit, that there would be an invoice or a grant stage payment request or a debtor raised for that?
We are seeing, potentially a debtor raised. It depends on the grant agreement, but we are seeing more grant agreements where the funding point is at the conclusion of delivery, and councils have been asked to effectively cash flow the delivery of the grant funded services up front. And in those circumstances, we would be expecting to see either an accrual or a receivable in relation to the grant income. So again, and you know, all care and no responsibility in the presentation, I guess, but the simplest way of thinking about that is identifying that performance obligation, and that's the point at which, when you meet the performance obligation, you recognise the revenue. And in some agreements, you may be meeting that performance obligation before you receive the funding, which is a receivable. Still in the vast bulk, I think you're receiving the funding before you deliver the performance obligation. So it's not common, but it's conceptually, and we are starting to see it. It's quite appropriate.
Yeah. So sorry to cut to so if we had a grant application that said it's payment on completion of the project and you're only part way through, you would think you probably wouldn't recommend because you don't have control over it then?
Well, no, if the performance obligations were very clear under that grant agreement as to what you were required to do. So say, for example, you were required to provide 100 hours of community services and you would be paid at the conclusion of that. If halfway through you've provided 50 hours of community services, then all things being equal, you'd be entitled to recognise 50% of that grant income.
Now we've got two more questions there from Fiona Hayden. What about if the project is finished, however, it has not had its opening, it says in a sporting club, so it has not finalised the milestone, would you accrue the grant income?
Yeah.
I think we've just...
Good question, because a milestone in a grant agreement is not the same as a performance obligation. I mean, sometimes they are very similar, but again, looking into the grant agreement, if the performance obligation is to build a community facility and the community facility is built, then, you know, again, all things being equal, you would recognise 100% of the grant agreement, even if the final milestone payment wasn't until the minister came out and cut the ribbon on the door or something along those lines. If you've done the performance obligation, which is the building of the building, you would be recognising all of the revenue.
This one might be for you, Fiona. Good floods question from John Welshig. With regards to assets affected by floods, will a restoration of the asset suffice as a reason not to impair the asset? Put on your engineer's hat here and tell us this one.
I would think so. If you've restored the asset or repaired the asset, it's no longer impaired. Happy for your thoughts, Martin, as well.
Yeah, I think Fiona, in essence, you're right. The only question is how you treat the costs associated with the restoration of the asset.
Mm-hmm.
So you wouldn't capitalise that and then not impair. Does that sort of make sense?
Mm-hmm. Yeah. Good point. Good point.
Yeah, but yeah, if you've repaired the asset before year end, then it's not impaired.
So those repair costs would need to be expensed, not capitalised.
Correct. I hate this because everything's a little bit more complicated than simple. But if the repairs or the restoration has improved the asset beyond the what it was originally pre-flood, then there could be a component that would be of a capital nature. So if you lost a bridge that was depreciated to half its value and you replaced it with a brand spanking new bridge, then it would be appropriate that bridge would come on at the new value. But effectively, that's only going to be 50% of the expenditure. Does that make sense? Yeah.
Does to me completely. And I know in our case, we've repaired a number of roads and we've just expensed those costs. Just over the last few months, we've just kept going out and repairing those roads. But we certainly haven't capitalised anything.
So any more questions, please put them on. We've still got a few minutes. I might just throw a bit of a general question and maybe target John and Fiona with this question. I know Travis Derricott at our last PD day talked particularly about La Trobe, made a positive mention about La Trobe's asset valuation report that they presented to their audit committee in June. And I was wondering about some of the good tips and things that you found with your audit committees and your auditors about where you're presenting financial data and maybe particularly, I know we have an explanatory document we prepare each year about just about every note in the annual accounts, which puts in a bit more information. I was wondering how you guys prepare and what sort of information you give to your audit committees and the auditors over and above what you'd see in your annual accounts.
Yeah, that's a good approach, Danny, and I'm sure a lot of councils are doing that already, but if you're not, do yourself a favour, prepare a companion report. It doesn't just have to be about the valuations, it can be about any changes to process. There will always be questions about whether accounting standards have changed and the impact of those. Just pick up the main issues and your policy positions. I find that cuts out a lot of time. The other little tip that I like to do is circulate a request for questions to committee members before the meeting and try and circulate responses as well to all the committee members. Then you don't have to take things on notice and you can find that it cuts down a lot of time.
Yeah, some really good points, John. I encourage preparing accounting position papers, which really touches on your point of picking a topic and outlining your position, the accounting treatment you've applied, to give them an update. We do lots of updates throughout the year as well. What we did this year is to provide an update on what the March indices were as far as asset valuations, just to give the audit committee a bit of a heads up of we are likely to have to revalue these particular classes of assets because the indices have moved, so much. So that's one thing that we've done as well. But accounting position papers is another thing that we do, just picking out a particular topic, such as landfill provisions. We've got a number of sites that we have to do significant rehabilitation works, and just what have we done as far as recalculating those provisions. So that's some things that we do, and just those regular updates, particularly March through to September, any of those audit committee meetings having updates to those particular meetings so that it's not all the information at once. We do have one of our audit committee members also goes through our annual accounts with a fine-tooth comb. So a bit like your point that you made, John, on giving information. So we usually have a list of about 10 to 20 questions. And what I've done is circulated that back to all audit committee members with responses so that they've got that information prior to that audit committee meeting on the accounts. And they all feel that they've been scrutinised very, very thoroughly. So it does minimise questions on the day, but a bit similar to your point of encouraging questions.
Martin, and from a practitioner's point of view, what do you see as some of the good practices in terms of the way finance teams present their to audit committees and to the auditors?
Yeah, I think there are quite varied practices, but the better practices that we see is where the finance team are providing appropriate position papers up to the audit committee to support the key components of the financial statements, so particularly around the areas of asset valuation, where there's been changes in accounting policies, they're running papers to the audit committees to support those changes. And then I think an explanation of the financial statements that have been included with the financial report in a relatively plain English process is often a really useful guide for the committee members. I think, and I have sat in a few audit committee member meetings where the members will do a page turn of the financial statement, which is time consuming. I find it more beneficial if the committee members are given quite a bit of lead time to look at the financial reports and the associated documents, and then use the question and answer sort of process so that all questions come back and can be addressed by the finance team before the actual committee meeting. That tends to streamline the process.
All good tips. I know we use explanatory documents to particularly things where you've got disclosure, particularly about contingent liabilities, and hopefully you haven't got too many of those. but you can put some detail to those that you can't put in there. You just can't put in the disclosure note because of confidentiality and a range of things. So we always use those. Look, thanks for that. That's some good stuff. So last chance for questions, and we might be able to give you back a couple of minutes. I hope it's been helpful with regards to that. I know I'm glad that the KMP and the senior officers note came up. I said, look, I think it's from my point of view, and from FinPro's point of view, it's one of the really good changes that we've been able to get through in terms of the model accounts. Just in terms of, because we know that that's an area that we come under a lot of scrutiny, and just by sheer weight of people, just by time served, that they're rolling into those categories. So that makes it a lot clearer and should make it a bit easier and better disclosure, I think, too. So if there's no more questions, I'd like to thank Martin, John and Fiona. And we've had a good turnout of people today. So thank you all for coming along today. Look, if there's a bit of, if you think this was positive, we might also look to do another webinar on the budget consultation process, because I know there's been a number of councils that have gone right away from the old 223 process. Everyone's gone away from the 223, but I know a lot of councils were replicating a 223 type process, still doing draft budgets in April and May, going out for consultation and then adopting in June. But I know there is a small number of councils that have gone away from that and have done their consultation a lot earlier, and then putting up budgets for adoption even in May. So if there's some interest in that, we might you maybe send some feedback either on the chat box here, or maybe send a note to Gabriel. You think that's a good idea, because then we'll do that. And I think just in terms of timeliness, it might be better to do that more sooner than later, because the councils that have gone out early have done that in October and November in terms of their consultation. So if there's any interest in that, please let us know. Other than that, look, thank you very much. It's been, I hope it's been good. I'm sorry I confused everyone with the order of the questions, but I hope you got all those. The team answered those really well, considering I was just talking to them and they couldn't see them. So well done, guys, and thank you very much. And thank you, everyone. Look, really good luck with all your endeavours to get your year-end accounts completed, and good luck with your audit committees, and I hope it all goes very smoothly. So thank you very much.